Can everybody see my screen right now?
Yes, Professor, we can see your screen.
Perfect. Perfect. The today classes is bond and the bill market in the United States. By the way, what we are trying to say, bond and the bills, the treasury bill and government bonds are three well-known fixed income financial instrument, which is approximately $1 trillion deepness in the United States. $1 trillion, meaning that the government bonds, which is generally a long-term asset, and the treasury bill, which is comparatively short-term asset in the United States government and treasury. And while making fiscal policy and while making the borrowing from the market, the government printing a government bond, let's say 10-year, or let's say 30-year or 50-year even, or the treasury, if they need the cash, they're printing the treasury bills, distributing those treasury bills to the investors, and making general coupon payments or perpetuity at the end of the maturity of the government bonds and treasury bills. Let me start the fixed income market dynamics in the United States. Please try to take a look at here on the top of the left. As you see here, this is the US Treasury yield, okay? And this is 2-year. These are the maturity, by the way. 2-year Treasury, 5-year Treasury, Treasury inflation protective security, 10-year and 30-year. By the way, generally, we should have a yield curve, something like this. Let me do this on my blank screen. Give me 1 second. Now I think everybody can see a white screen on the desktop, right? Yes. And please don't move your mouses on the white screen. Please don't move your mouses on the white screen. Just follow. Please don't move your mouses. Please. Here somebody is moving his mouses. Please don't move your mouses. Here, I'm trying to make here, as you see on the dashboard, this is a basic yield and maturity axis. On the x-axis, as you see, we have time. This is the maturity. 3 months, 6 months, 1 year, 2 year, and 5 years. And on the y-axis, you will see the yield. This is the yield on your investment. How you make money at the end of this. If you put your money for 3 months, you will get 3.5%. Or let's say if it is 6 months, it's 4%. And if it is 1 year, it is 4.5%. And the 2 year is 5, and the 5 year is 6%. And as you see, if the maturity increases, meaning if I have long-term investment here, my yield is increasing because of positive slope of the yield curve. This is positive slope yield curve. As the time increases, my yield is increasing, right? But if I do this, please look at now my US Treasury yields. What you see, the 2 year is 4.59, but 5 year is 4.21. The time is increasing longer term, but the yield is decreasing. Or let's say 2 year is approximately 4.60, but 10 years just 4.20. You are waiting longer term, 8 years, but you are getting lower yields. This is abnormal, right? Because normally, as you see here, the yield curve is a positive slope. Please take a look at it again. Please look my screen again. As you see here, this is my yield. And if the time is increasing here in the maturity side, the yield is increasing as well. But currently in the United States, there is something wrong, something like this. 2 year is approximately 4.60, and 10 year here is just 4.20, and the yield curve is something like this, not like this. It is like this. What is the main problem here? If you understand the concept behind the yield curve, here as you see, the 2 year is approximately 4.60, but the 10 year is 4.20. The time to maturity is higher, but the yield is lower. This is called as converted yield curve, meaning that if you wait more, you will get less. What is the basic reason behind it? Because normally if I have something like this, meaning that if time to maturity is higher, yield should be higher. This is the normal positive slope yield curve, meaning that there will be a positive inflation in the market. Why? Let's say Felipe, Augusto, or let's say Majagne make an investment in their money, and if there is an inflation in the market, let's say 2%, and I'm putting $10 million for the 5 years United States Treasury. Every year, I will face with 2% inflation, and my money melting 2% each year because of the purchasing parity coming from the United States inflation, right? So let's say today I have $1 million, and let's say my return yield is each year is approximately 4%, and I'm getting $40,000 each year, but at the end of the year, I'm not getting the same bread in the market with the same prices because of the inflation. I'm losing my purchasing power parity, right? So for those 2% of inflation, I'm requesting from the government that you should give higher money to me because my money is melting because of your inflation in the market. So if there is positive inflation, yield should be higher and it should be compensate your losses in the market, right? But if I expect the inflation will be lower in the market in the next couple of years, I don't need to increase my request from the government, please pay me more, right? Because I don't need higher money. My money will not be melt because of the higher inflation, because I'm expecting lower inflation in the market. Then the yield curve is negative slope. As the time is increasing, yield is decreasing because inflation will decrease. So if you look at this table here, it is 4.60%, and the 5-year treasury yield is this, and 10-year is 4.20, meaning that the investor waiting higher inflation in the short term. In the 2-year treasury, as you see, I'm expecting higher inflation, so I want higher return. But in the longer term, I'm expecting lower inflation, and I'm accepting those lower yield in my money. So just looking at the shape of the yield curve, now you can understand whether the inflation will increase or decrease in the near couple of years. Okay, inflation expectation will directly reflect to the yield curve of the United States Treasury bill or the government bond. And now, as you see, these are the yields, but these are the dreaming yield, right? These are not realized. But what is happening year to date, as you see here, year to date, 2024 year to date return in 2-year treasury, it is positive. But if you put your money in longer term money, it is approximately minus 80%, right? Minus 0.8%. Or let's say, if you put your money in the United States for the 10-year treasury yield, you will lose approximately 160% at the end of the session until today. Why? Because the inflation is decreasing and because the rate cut process started in the United States, you will lose your money. And now, by the way, here I have average maturity, meaning that people wait here until the end of the 2 years. Here as well, people wait approximately 5 years, but here TIPS meaning treasury inflation protected securities. What does this mean? Sometimes to compensate your losses because of the inflation in the United States, treasury can print some securities like TIPS. It's called as treasury inflation protected security, meaning that you will not lose your money because of the inflation, because I will cover the inflation loss in the yield of this treasury security. Okay, so the yield to maturity in this security is approximately 7 years and 3 months. And for the 10-year treasury yield, approximately 10. And here, approximately maturity is 30 years. And the correlation to the 10-year treasury yield, meaning that if, let's say, 10-year treasury yield increase 1%, 5-year treasury yield increase 0.94%. This is showing the correlation. And as you see, 10-year treasury yield approximately and exactly same as the 10-year treasury yield. It is 1. If it is increased 1%, it will increase 1% as well. But 30-year treasury yield will increase 0.93%. So, meaning that longer term yields highly correlated with 10-year treasury yield, while the short-term yield is approximately only 0.75% correlation with the 10-year treasury yield. And here, correlation to the S&P 500, meaning that what happened to the stock exchange, S&P 500, if there is an increase in the treasury yield of the United States. If 5-year treasury yield increase, the correlation is minus. Correlation minus, 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 meaning that if people increase their demand in the securities of the loan and the bill market of the United States, you will lose your money in the stock exchange. Why? Because the main reason and one of the most important topic and the message should be given in this class is this. Fixed income like treasury bills or government bonds are the risk-free asset. Okay, there is no risk in this type of investment. Okay, at the end of the session, you will get your initial investment at least. But in the stock exchange, let's say Apple equity or Microsoft or Amazon, or let's say Alibaba, or let's say Nike, Adidas, or Volkswagen in the Germany. If you put your money for the stock exchange in DAX in the Germany, for the Volkswagen company, because of the electrical drivers covering the market and the demand for the conventional vehicles like the Volkswagen or Daimler, Mercedes-Benz, decreasing in the market, and they are losing their prices and the sales. For that reason, you will lose your money in the stock exchange because you are putting your money in a risky asset. Risky asset means stock exchange. Stock exchange, the Volkswagen, or let's say Microsoft, Amazon, Tesla, these are the stocks in the market, equity exchange, stock exchange. And if you take a risk, if the price is increasing, you will get huge money. But if the price decreasing, you will lose your money as well. But in the fixed income, these are fixed income as given from the name, fixed. The income is fixed. Okay, no risk. Just this is coming from the volatility. Okay, and here we have some sectors like the US aggregate, investment grade corporation, convertibles, United States high yield bonds, municipals, mortgage-backed securities, and asset-backed securities. These mortgage-backed securities and asset-backed securities in the market is coming from the COVID-19 crisis or global financial crisis and those type of volatility in the market. For that reason, we can easily understand that. Give me 1 second, please. Sorry for the interruption because it is coming from the direct line. As you see here, mortgage-backed securities and asset-backed securities is coming from the COVID-19 crisis extraordinary case. What does this mean? When the market is encountered with the problem and the crisis of the COVID-19, the United States Federal Reserve decided to increase the money supply and quantitative easing process. What we mean by quantitative easing? Quantitative easing, the Federal Reserve, United States Central Bank is saying that I will buy from the market some papers like asset-backed securities and mortgage-backed securities, and in return, I will give the United States dollar as a huge amount each month, approximately $85 billion. $85 billion each month. I will buy asset-backed securities and mortgage-backed securities from the market. And what is the reason behind it? Please take this money. This is cheap money. There is no cost. My interest rate is in the zero lower bound. Take this money, purchase it, consume it, and increase the demand in the market because there is no inflation and demand in the market. Market is contracting. This mortgage-backed securities and asset-backed securities is coming from the crisis period. This US high-yield municipals or convertible or investment-grade corporation is always in our life, even last 50 years. And here, as you see, please take a look at this. This is also a summary of the story, how the fixed income market is working in the United States. The impact of a 1% rise in or fall in the interest rate, what is happening to other assets in the United States, or let's say other assets in the corporation or the government. What's happening to those? Let's take a look at impact of a 1% rise in or fall in the interest rate. It is increasing the 2-year treasury yield. Okay, please take a look at the title here. As you see, 2-year United States Treasury, 5-year United States Treasury, treasury inflation protected security, 10-year and 30-year. And what we see here exactly? We see here that sometimes in the short-term yield, even the decrease, even the increase. Please look at this one. Total return. Assume a parallel shift in the yield curve, meaning that if there is an increase in the United States interest rate, meaning policy rate, the Federal Reserve rate, the 2-year treasury yield is increasing. But if there is a decrease, 1%, 2-year treasury yield again increasing. This is a little bit weird. But in the short term, there is huge volatility in the market. It is coming from the volatility. But for the long term, if there's an increase, rise 1%, 5-year treasury increasing. But if there's a fall, it is just decrease minus 0.2. Or treasury inflation protected security is something like increase correlation is 6.4%, but decrease is higher than that. What we see here, as the maturity increasing, an increase or a decrease in the United States policy rate make higher volatility in the longer term asset, as you see here. If it is short term, it is just 2-5%. But if it is long term, it is like 12 or 20%. So I can easily understand that if there is a increase or decrease in the United States Federal Reserve policy rate, the longer term asset like 30-year or 10-year treasury yield will increase or decrease in a huge volatility. Okay. And please, definition is here. Please take a look at it. This is the treasury yield curve. As you see here, the definition, the United States treasury yield. These are yield over 15 years. Okay, these are the yields over 15 years. Please take a look at this table first. Please try to understand the shape of the curve at least. Now, I can directly say to you that a few minutes ago, in a white black dashboard, I draw this axis. As you see, here the maturity, 3 month, 1 year, 2 year, 3 year, 5 year, or let's say 7 year or 10. And here the yield we have. In the January 2024, it is a positively sloped yield curve, right? Like you see here. As the maturity increasing, please look at the shape of the yield curve. As the maturity increasing, the yield curve has a positive slope. The yield is increasing. But now, as you see here, in the March of the 31, 2024, today, approximately 2 quarters ago, it is an inverted yield curve. Higher yield in the shorter fixed income. If I have 3 months, it is 5.4, but if I have 10 years, it is 4.2. The shorter term has a higher return. Why? Because inflation will be decreasing in the next couple of years. So there will be no higher return in the market because of the loss coming from the inflation. And now, here we have high yield bonds, default rate, and the spread to the worst. And here, default rate, spread to the worst, and the recovery rate, meaning, please take a look at this gray dash line. These are the crisis period. 1991, the Gulf crisis in the Middle East, dot-com crisis in the United States, global financial crisis in the Wall Street in 2008, and the COVID-19 crisis here. These are the crisis period. And as you see, default rate is directly increasing in the crisis period. But normally, the default rate is really low, even less than the 4%. So default probability in the fixed income asset is almost impossible if the government and country is there. And now credit maturity and the default risk, investment grade bond and a high yield. So what we mean by investment grade and a high yield? I'm sure most of the people here, the credit rating agencies like the Moody's, S&P, or Fitch. These are the global rating agencies, the Fitch, S&P Global, and the Moody's. And according to the credit rating of these companies to the government or the corporation, we can decide whether this government or this company has an investment grade or not. Okay, let's say Moody's giving B++, meaning that this is in an investment grade for the corporation. But if it is B-, no, this is not an investment grade for those corporations. So there is some categorization for the S&P, Moody's, and Fitch, according to which alphabetic order we are giving the investment grade. An investment grade meaning you can make an investment and with lower risk, you will get the money. But the high yield meaning you will get a high return in your investment, but there is a huge probability of the default risk as well. The company can go to bankruptcy. Okay, you are taking the risk. Don't forget this sentence. If the risk higher, the yield is high. Okay, if you are taking higher risk, you will get higher money, but also you can lose higher money as well. But in investment grade, your loss here and your yield return is here. So tight band. But in high yield, it is something like this. Loss is here and yield is here. You can either lose huge money or you can make a good money because of the high yield. But there is a huge volatility and the risk in this asset. And here, index weighting by credit rating, as you see here, these are the credit rating agency BB, or let's say B. Or there are some C, these are really junk bonds. These are like trash. Okay, there is only some people who is making gamble, put the money for those type of bonds and bills. And here, please take a look at this one. This is also a good summarization of the fixed income valuation in the United States or throughout the world as well. Please try to understand the chart first. Please take a look at the bars and what these bars showing us and what they are trying to summarize for our understanding. What is exactly summarization? Here, as you see, fixed income valuation, yield to worst across fixed income sectors. This is yield to first across fixed income sectors. This is percentage yield, and this is past 10 years. And please try to understand here, this long bar, this black bar is 10-year range, meaning lowest and the highest value. And this purple one is 10-year median here. Okay, these small bars are 10-year median. And this dark blue is the current ratio. Please take a look at this. US Treasury, municipals, investment grade corporation, mortgage-backed securities, asset-backed securities, Euro investment grade, emerging market corporation, Euro high yield, United States high yield, and leverage loan. And please, if you are buying something, and while making your valuation, to decide whether this is cheap or expensive, there are some different rules, but one of them is basic rule. Yes, after this basic rule, if we are a high financial literacy, we can make other cross checks as well due to our investment. But in any case, we should put in mind that The first principle is this: if the current is higher than the average, it is expensive. Okay, if the current is higher than the average, it is expensive. Please look at the United States. For all the ratio, the average is lower, or the current ratio is higher than the average, meaning that here for the United States case, almost all is expensive in the fixed income. Okay, but let's say here emerging market, the 10-year average and the current ratio is all exactly the same, so emerging market is cheaper. You can buy from the emerging. But for even the United States or Europe, all the current ratio is higher than the 10 years average, meaning that these fixed income assets are expensive. And today, it is not a correct time to buy and make an investment for those assets. And how this bills and the bond market is correlated with the developed market monetary policy. Please take a look at here. These are the bond purchases of the central banks. Okay, what I called a few minutes ago, mortgage-backed securities and asset-backed securities in the market. And I'm trying to make a forecast here that showing that how much the bonds, the central banks buying from the market. This black one is Fed here. This dark blue is Bank of Japan. Light blue is European Central Bank. The light green is Bank of England. And the orange one is total. Please look at after the COVID. Almost $5 trillion. $5 trillion asset is bought by the central bank for those 4 countries. Okay, 5 trillion bonds, huge money, even higher than lots of countries' GDP in the market, just during the COVID crisis. And now, as you see, they are selling those bonds to the market. Why? Because quantitative easing period is end up. The United States stopped the decrease in the interest rate because they see that there's an incentive in the market. Consumption and demand is increasing. Inflation is rising. So there's no need to give extra and cheap money to the market to increase the demand, because demand is satisfied and it is compatible with the current inflation projection. So there is no need to buy additional assets from the market. What we need, we will sell the bonds in our current portfolio in the central banks, and we will start the quantitative tapering process. It is increasing the interest rate. And historical policy rate and the forward curves here, as you see. Let me take a look at this one first. This historical policy rate and Federal Reserve, ECB, the Bank of England and the Bank of Japan here again. And I can easily understand that this light blue for the ECB and the black one and the light green one is the Federal Reserve and the Bank of England respectively. And their interest rate peaked up approximately 5.5% in the middle of the 2024. It has peaked for the European Central Bank as 4%. But today, as you see, we are here. Okay, we are here, almost here. We are. And today, United States decreased interest rate 2 times. And it is approximately 4.75% today. And for the European Central Bank, it is 3.75% today. But at the end of 2025, it will decrease approximately 2%, which is exactly the same the inflation target of the European Central Bank. But even until the end of 2027, the Federal Reserve and the Bank of England will fund the market higher than the 3%, which is also higher than their inflation target. And here, as you see, the same United global fixed income. Please look at this first one. This is United States yield and the return. And now we are taking a look at the global fixed income market. And it is United States, global excluding United States, Japan, Germany, United Kingdom, Italy, and China. And as you see here, today the lowest one in Japan and China, because there is a deflationary process in Japan approximately last 20 years. There is no inflation in that market. So the yield return is really low. And the China, last 5 years, their yield are also decreasing because there is a decrease in the prices, or there's a deflationary process. Okay. And here, if we look at the global bond market, please look at the numbers. It is really, really important. What is the global bond market today? $140 trillion total. $140 trillion. Ladies and gentlemen, even the Italy, a big economy, or even the France, a big economy, just have $4 trillion GDP, meaning that during 1 year, 50 million people producing without any consumption just 4 trillion. And as you see, the global bond market is approximately $140 trillion, meaning that 30 times Italy or France. Okay, huge money. This is really huge money. And the municipal finance. As you see, in each government, in each cities, we have municipalities, and they need some money and the cash to make their investment. Like the treasury, they are also printing some financial instruments to borrow from the market, and these are municipal bonds, like the government bonds. And here, as you see, these are BBB municipal government bonds, and their return is here. They have higher return because their risk is higher than the government, right? Government is almost there, but municipalities can change from between the parties and the people. For that reason, the risk is higher there and the return is higher there. And here, state and local and federal net debt. And the net debt in the United States is really high today. It's approximately $35 trillion. And the United States total state and local federal net debt, overall debt, is higher than the gross domestic product. Normally, this is also higher in Japan, but it is not a problem for Japan because the total debt in Japan today approximately 200% of the Japan GDP. But why it is not important? Because almost all debt is domestic. There is no international borrowing for the Japanese. But for the United States, this is a problem because most of the debt is coming from Europe or Middle East. And here we have Bloomberg United States aggregate annual return in intraday decline. This is a historical range. It is starting from 1976 and until today, approximately 50 years, and showing that despite average intra-year drops of 3.5%, annual return is positive for the 43 years of the 48 years, meaning that only just 5 years. Some decline cannot be compensated. But for the 43 years, during these 50 years, we compensated our losses because of sharp decline in the United States aggregate return for the government bonds. And the sources of the bond total market, as you see here, we have some charts, and here we have dates. It is from 2004 until 2024, meaning approximately 25 years here. And what is my return is coming from? Change in treasury yield is dark blue. change in spread of treasuries is light blue, and the coupon payment is gray, and the total return is dark black. And as you see here, the most of the income is coming from the change in treasury yield and the coupon payments, right? Coupon payment means if I put $1 million for the 10-year treasury yield, each year they are paying me $1 million. At the end of the 10 years, I'm getting my $10 million again because of the coupon payment. But if I wait 10 years for just for 1 million and if I get the same money, is it fair? No, because other than the coupon payment, you will get also your price return at the end of the session. Coupon payment making your money as secure, and the risk return coming from the changes in the prices making your money is valuable. And the last word from my side is valuation monitor. These are the Z score. Again, as you see here, treasuries, United States core bond, EM equity, the developed market equity, United States small corporation. One of the microphone is open. Please wait just 1 minute because I will give the microphone to the attendances. Here you see the January 2023 and the current ratio. The 1 year ago it is light green and today it is dark green, as you see. And these are the range for the asset valuation for the different countries. And as you see here, yield to worst, price to book ratio, these are price earning ratio. So I can easily understand that from